Are you wondering what would be better, doing a second loan, Heloan or Heloc? Do you know the difference? We're gonna talk about this. Max, let me explain you, okay? When you have a house with a lot of equity, let's say you bought a house probably 2015, 2020, you probably paid for the house, what, $400,000? Just to give you an idea, average price was in the Antelope Valley or $800,000 a house in Los Angeles area, San Fernando, Santa Clarita. That house today maybe is worth in the Antelope Valley $600,000, $700,000. On LA area around $1.2, $1.5 million. So for a Heloan or Heloc, you can go up to 80% of the property value to get the difference on the equity. So if you owe $400,000 when you bought it, and now the property value is $700,000, 80% loan to value of the $700,000 will be $560,000. $560,000 will be the 80% of the property value as today's value. If you have a balance on the first loan of $400,000, the difference between $560,000 and $400,000 is $160,000. That would be the equity that you can enjoy or use with a Heloan or Heloc. And now the question is, which one would be better, or which one would you be probably using on yourself? We in Clear to Close Home Loans, we are approved to do all of them, either Helocs or Helocs. The main difference, Helocs start from home equity line of credit. That means it's a home equity line of credit on the property. Line of credit means you're just gonna have like a credit card that you can use as much as you want and need with any amount that you want. Approved for that second loan. In this particular scenario, $160,000. So you get approved for $160,000 Heloc. That means you have $160,000 available like a credit card. You're not gonna have a credit card to use it to pay on the store. You're gonna have a checkbook, and you're gonna have an online account where you can transfer the money from that Heloc to your regular checking or saving account. You're gonna use as you please, as much as you want, up to $160,000. So that means you can get approved a Heloc even if you don't have any balance on it. You don't have any balance on it, you don't have to do any payment on it, of course. It's like a credit card, exactly the same thing. If you need $20,000, let's say you wanna fix the kitchen on the house, then you pull $20,000 out, or you transfer $20,000 from the Heloc to your checking or saving account, or you can write down a check for $20,000. It's like a checking account, but it's a Heloc, it's a debt, it's a line of credit. And then that balance is the balance you're gonna be paying monthly for the interest. The interest today for the Heloc is 1-2 points over the prime rate. So if the prime rate is around 7.5, the Heloc rate is gonna be around 9.5, just to give you an idea. And it's gonna be adjustable. The Heloc is adjustable, it's not a fixed rate. That means every month it's gonna be moving depending on the rate of the market. Every year there is a cap. There is a limit on how much the rate can go on the Heloc. So the basic three difference are you pay the payment based on the balance you have at the moment. Second, the rate is adjustable. Third, you can have the Heloc with zero balance and no payments, or you can max it out and do interest only payment. There is no principal payment on the Heloc. Those are the three main things on the Heloc. And now the question at the beginning of the video, what would be better for you? What's better, having a Heloc or a Heloan? The difference between a Heloan and a Heloc, the Heloan is a fixed rate loan. It's a loan fully amortized. You can do interest only at the beginning, but eventually after 10 years, it will be principal and interest. You're gonna have a balance, the whole amount that you got approved for since day one. If you got a Heloan and you got approved for $160,000, your loan will be for $160,000. And the payment will be fixed. Let's say your payment is $1,000 a month for $160,000 fixed rate, fixed loan for a Heloan. That payment is gonna remain the same, even though you pay extra towards the principal. Whenever the Heloan is zero balance, the loan is closed. You don't have any debt, you don't have any payment. So those are the basic difference between Helocs and Heloans. Heloans are fixed. Heloans is gonna be principal and interest most of the time. And Heloans, you have a monthly payment that's gonna be the same until the loan is paid off. No adjustable rate. Which one do you like the most, huh? Now, last but not least, on Thursday's update. What's better, doing a 1-0 buy down or a 1-2 buy down. It's very popular today. 40% of the purchase loans today are buy downs. You know why? Because the client is having the flexibility to start the first or the second year with a lower payment, with a lower rate for that 1-2 years. And then it's gonna go to the regular normal rate on the market. Let's just give you an example. Right now, FHA rate with me, a clear to close home loan, the rate is at 6.875, 30-year fixed, just right now. Yes, today, August the 30th. If you do the temporary buy down, 1-2 temporary buy down, that means the first year, the rate is gonna start at 4.875. So 2 points less than the regular market rate. In the second year, the rate will go to 5.875. And then the third year will be the regular 6.875, assuming you want to keep the rate that low. Why are we doing this kind of promotion? Why the lenders are doing that kind of this rate at the beginning? Because we know 1-2 years from now, the rates are going to drop. And by then, you're going to do a refi on your house, and you're going to just keep the rate lower the way it was at the beginning. You don't need to get the newer rate. The question today is it better the 1-0 buy down or the 1-2 buy down? The 1-0 is only 1 year temporary buy down. So you're gonna have 1 point less on the today's rate market. So if today's rate is FHA 6.875, the first year is gonna start at 5.875, only 1 point cost. Usually it's better paid by the buyer, the seller. The seller gives you seller's credit for the closing cost, you use that credit to pay the buy down. 1 year, because we are expecting 1 year from now, by the end of next year, to start to see the rates in the low 5%. So whenever the temporary rates ends at the end of next year, then you're gonna be able to refi to bring it even lower and save money, and you're gonna just keep your regular loan and rate. The 1-2 buy down was a very good option at the beginning of the year, because at the beginning of the year we were expecting to have 2 years on the transition for the lower rate than what we have today. The 2-1 buy down is gonna be more. It's gonna be more expensive. It's gonna be 2 point cost to bring the rates 2 point lower than the regular market rate. So the question is pretty much up to you. Do you have the money? Do you have the seller's credit? Do you want to have 1 year buy down, or do you want to have 2 years buy down? What do you think? Let me know. And last but not least, like I was saying about the rate, we have a brakes on the rate. Finally, the people or the market is starting to ease the rate. It's been going up for the last 2-3 weeks, more maybe, and now finally back down a 1/4 point. So let's see what happens, huh? What do you think? That's it for now. Carlos Lopez, Clear to Close Home Loans. Give me a call if you need any help. Having this labor weekend in home, relaxing. I have classes to do to renew my broker's license, and that's it. God bless you. Bye bye.